firms, in some cases, find funding, but in most cases, we do venture evangelism to try to get people aware of what's going on in the private markets and or public markets. I'll let Mark give you a little background in just a sec. My short background is that I came out of college, came to the Chicago Bears, played football there for all of 4 games, got cut, so I'm good at plan Bs, because that was my plan A, was to play pro football. But luckily got 4 games in, then Mike Singletary took my job. I went down to the trading pits, hated it for about 3 months, and then got pretty good at it after those 3 months. Built a firm up, sold it to Citadel in 2004, started building a brokerage firm called Trade Monster, Option Monster, 401k Monster. Should have had Venture Monster too. But sold that to E-Trade for $750 million in 2016. And since then, Mark and I have both been building businesses and going around the world talking to investors like yourselves. I have got no hard sales pitch for you guys today, but we'll give you our insights on macro, what's going to likely happen today and so forth in just a sec. But I'm going to hand the mic to Mark.
Well, thank you very much, John. It's great to see so many familiar faces and friends, and to catch up with some of you. Neil, I haven't seen in early years. It's good to see you, sir. And thank you, Mark, for giving us the opportunity to address what is always a very high-quality crowd.
And you guys have karaoke skills.
Well, one of us.
Oh, I've heard you singing in Pat O'Brien's in New Orleans.
Well, that's a whole other conversation, and the subject of a different breakout session.
Let's talk about that.
But well, one thing I do want to say, you know, I think it would be irresponsible of us having the opportunity to come on stage here following that incredible women's panel, not to point out something that one of our friends and co-investors who dropped in on us in Miami, Kevin O'Leary, says all the time, and love or hate Kevin, and I know there's 2 sides to that argument. He says all the time that the women-run, women-led companies in his portfolio consistently outperform from a return perspective that of their the men-led and men-run companies. And when I was running a law firm, which I did for many years, I hired mostly female attorneys, and they outperformed their male counterparts. So I think it's important for us just to point that out. So as John was saying, I'm on Wall Street, for those of you that don't know, about 27 years. Ex-4 trader, started out in New York when we still traded in fractions and using paper. I know I don't look that age, but it's true. Left the floor, was on the institutional sales and trading desk for Lehman, then went to law school, practiced as a securities lawyer for 20 years. Some of you in the room actually had as clients back in the day. And then about 10 years ago, co-founded a company called Battlefield, which is an alternative data space, which I could talk about forever, but it won't. That was my first step out of the boat of practicing law full time. But while I practiced, it was always capital markets, VC, alternative investments, both on the buy and the sell side. 4 years ago or so, I started IDI Partners, which is a boutique multifamily office that John, his brother, and 3 or 4 other partners of ours put together to invest in Series C and Series A venture stage businesses, a lot of tech, fintech, database stuff, but also some esoteric investments as well. We invested around $143 million in about 8 companies. And what we found was each of those companies needed the same group of things to help in terms of accelerating introduction to other investors or to customers or what have you. So we started the advisory business that John mentioned before. But the thing that I think we like to do most is as market strategists. So John, of course, has been on CNBC, Fox, and just about every other mainstream media network you can think of for 20 years. I've been a contributor to CNBC and Fox for 15 years. You can see us on Liz Clayman's show, Charles Payne's show, Mary Romo's show, et cetera, et cetera. Too much?
Share some knowledge.
Drop the knowledge now? Okay.
Let's do it.
So we wanted to cover 3 things. One, the impact of Silicon Valley Bank's collapse on the VC ecosystem. It's something that we've been talking about a lot. It's very, very important. particularly in terms of the role of family offices, stepping into the void that has been created, by the SVB, collapse. The second thing, maybe we'll start with the second, is macro. It's impossible for us to talk to a group like this without giving our insights on interest rates and the bank crisis and all that. And then I think from the ESG and impact focus of this particular event, we had the president issuing his first veto ever of his administration on this very subject as it relates to the management of retirement accounts. And without getting political, we want to just unpack that a little bit. So, John.
Yes, sir.
Macro, what the heck's going on? You know, we're waiting for
2 o'clock.
Jay Powell, right? What's going to happen?
Jay Powell is going to move 25 basis points higher today. Mark and I both think that they've gone too far already. Should have gone bigger far longer ago, in our opinion. You could disagree with that all you want. But I think what they're trying to win back is some credibility here, and the fact that Ms. Lagarde over at the ECB last week raised by 50 basis points to combat inflation over there in the midst of the same banking crisis, the one that then crippled Credit Suisse, that more or less was already pretty crippled, but was following on the heels of Silicon Valley Bank, Signature Bank, First Republic, Western Pacific, PacWest, as well as Western Alliance. By the way, the guy that I sold my trading firm to, Ken Griffith at Citadel, took at least a 5% stake in that bank, Western Alliance, WAL, as it fell to below, I think, $7. And it's back now to $34 or thereabouts. I think the fact that they're going to move at 2 o'clock today, and then the Fed chairman will speak at 2:30, obviously market-moving events. I think there's a lot of opportunities.
We have our energy transition panel at 2:30.
All right. Well, that's perfect. And by the way, once they're done moving on these rates, Mark and I have already bought, so we don't just tell people what they should do. We tell people what we're doing and what we've done. So we've bought pretty significant positions in silver, in gold, because those are things people go to both because of financial duress, as well as at the end of a hiking cycle, if you put and overlay that against silver in particular, but gold as well, you see them react very well once the Fed is done. And I think the Fed is really close to done. They'll probably do at least one more 25 basis point move after this one, and then hopefully inflation's down into the 5s after that. But I think it's pretty obvious we're going to see something like that today, Mark. And we also, by the way, have been buying a lot of First Republic. We started buying too high. We started buying at 16 basically on the way down, but then we're able to make some profits on the short side and reload it at about $12 a share. So we're betting that they are one of the banks that gets saved and goes through to the upside. But we've played Signature Bank, which is SBNY. We've played the Silicon Valley Bank and a number of these in the space. I think they have no choice. They're going to survive or be bought. So I'm going to throw it over to Mark.
Yeah, no, I mean, I think that's, the market is priced in 25 basis points, and the market's also expecting the commentary from the Fed today to be both dovish, to indicate that they are getting to the end of their rate rising cycle, as well as to provide some cold comfort to investors around the safety and security of the American banking system, right? And of course, the other thing, which we could do a panel on its own, but I think we need to move to the next topic, is whether or not the FDIC insurance level is raised. We think it will be raised, probably almost to as much as $1 million. But we also think that it's become something of a red herring, as we said on our, we have a radio show as well called Bulls, Bears, and Blockchain that's also been #1 and 2 ranked Twitter spaces in the world for the past couple of weeks, which we encourage you guys to tune in and listen to. But I think that's become more of a political ping pong ball, because what the Fed has essentially said with what they did with SVB and others is, it's all backstop, right? So we could raise it to 5 million, 10 million, it doesn't really matter, because in times of crisis, the Fed is ultimately going to step in and guarantee those deposits. So SVB and the impact of SVB. One of the things, that being in the VC ecosystem for as long as I have been, both as a lawyer, as an investor, was very highly sensitive to what happened with Silicon Valley Bank, not only from the perspective of triggering this, global banking crisis, but also from the perspective of the elimination of a bank that essentially really almost created, along with, arguably Y Combinator and Andreessen Horowitz and others, but certainly sort of refined the art of venture debt and what relevance venture debt has had in the cap stack for venture-backed businesses. And we really did avoid an almost mass extinction event on that, 2 Mondays ago now.
Mm-hmm.
If, 65,000 some odd companies, which was the metric that was being used, half of the pitch book list of venture-backed businesses, did not have access to their deposit accounts or payroll and things of that nature, we could have seen companies that would have been the next Uber, Amazon, Google, right? Those were all venture-backed companies at some point in time, and of course, companies that have created, tens and hundreds of thousands of jobs and contributed to the economy. We could have seen 60,000 or more of them die or be at risk of imminent death. And so that was one of the reasons why, although I don't know that it was necessarily at the front of the Fed's mind or the Treasury's mind in doing what they did with the backstop, but we were certainly, as people that are in the VC ecosystem, happy to see that. But so what does this mean? It means that credit conditions are going to tighten in general, right? But particularly as it relates to the availability of credit and venture debt for venture stage companies. We are currently and actively talking to the companies within our own portfolio, several of which are in the process of raising capital. Shockingly, I say all the time, if you're a Series C investor, you're an A investor. If you're an A investor, you wind up as a B investor because you kind of get dragged along into these rounds. So we are actively talking with and advising the companies in our portfolio to reconsider the structure of their debt offerings to get terms that we think are more in line with what the market will accept, which, by the way, is a work in progress and something that we're currently trying to get right. But I think more particular to this audience, we have always felt that family offices have played an essential role in the venture capital ecosystem. And it's a role that is only going to become, it already has become, more important and more relevant with SVB being out of the picture. And as debt becomes less available, certainly on terms that are palatable to founders, and equity provided by this particular category of investor becomes more important. So, John, you want to?
Sure. And again, to the panel that preceded us, the ESG right now, well, it topped 41 trillion last year. It was, at the beginning of the year, they thought maybe by 2025 we'd be at 50 trillion for ESG investments. And obviously we're probably pretty close to that right now. So that is a category that I know is near and dear to many of your hearts. And it's certainly one that will continue to, I believe, thrive, because I see a female CEO right there with Proteus. And we're going to see a lot of those successful companies get venture backing, family office backing, and that's just a natural next step. It's not just, Blackstone and BlackRock saying that they're ESG, and they are, but it's also rooms like this full of investors that are focusing on those stocks, on those ventures, and giving them the support that they need. And I think that just continues like crazy, Mark. As far as other things, I'd say keep your eye on energy, because we already spoke briefly about what's going to happen if indeed the Fed moves 25 basis points again today. I think as they have saved the banks with these backstops, that takes that extinction event off the table that Mark spoke of, and it means that the energy, which was $80 per barrel for West Texas Intermediate, fell all the way down to 66. It has now moved back to 69-ish, and I think if they get follow through on what they've talked about with FRC, which is First Republic, and other banks, you're going to see energy make a fairly significant comeback. So I'm always a little bit focused on energy. We have so many good friends who trade it, like Mark Fisher, one of the biggest private energy traders on earth. And I buy it on dips like the one we saw that took it down to 66 a barrel, or took natural gas down into the $2.30 per million BTU area recently. So I'm a bit of an energy bug in that space right now because of where they are. You know, rather than chasing them at the top, I love buying them at the bottom.
Yeah.
Can you talk to that veto?
Yeah, so, as many of you know, President Biden used the veto power for the first time in his administration to prevent a bill that would have blocked fiduciaries from taking, ESG considerations into account in the management of retirement portfolios. And this is pretty controversial. I think it's very beneficial for the ESG ecosystem. It's going to mean more asset flow coming into ESG-backed or ESG qualifying of businesses. But it is very controversial because, you know, the ERISA bill, let's put the lawyer hat on for a second, but the ERISA bill really requires pretty explicitly that the only thing a fiduciary of retirement accounts be concerned about is returns, right? For preservation of capital and returns. So while from the ESG perspective, we certainly think that it's a good thing that we'll see more capital flow, but we are a little bit concerned about what the impact could be, because any sort of creep away from that core fiduciary obligation, preserve capital and maximize returns for retirement accounts is a dangerous thing in a completely politically agnostic world. So this is a pretty major big deal that's going to be impacting both the ESG space and the ERISA retirement space as well.
In just a couple minutes, I have to go do a streaming show. So should we ask them if they have any questions, Mark?
Yeah, sure.
Yeah, question? You got Bob?
I can tie this to the banking crisis and the Women Founders. There's a women-founded bank called Custodian Bank by Caitlin Long.
Yep.
I'm sure you guys are familiar.
We've met Caitlin a couple times, yeah.
Do you see like banks like that, which are custodian banks, which don't do fractional reserve banking? They just basically plant your money with the Fed and they get 5% from the Fed and they pay you maybe 3%. Do you see like more opportunities with banks like that, which just hold your money and, you know, given what we're seeing?
Yeah, I mean, so, she was, when we did that event,
A year and a half ago with Cynthia Loomis, Caitlin was actually with us that evening. I love the neobanking space, right? And we're actually looking at, and I won't talk about it because I think some of the people in this room may know that, we're looking at a deal right now that's a neobank for crypto custody and all of that. What concerns me is that what's just happened, right, both here internationally in terms of a banking crisis, does not exactly provide warm water, right, for coming up with new banking concepts and new ideas. So while I love it, and we're looking right now because we see the massive void that's been created as a result of the failure of Silvergate and Signature, which were the two primary, if not exclusive, crypto fiat rails for US-based asset managers, there's opportunity there. But man, oh man, getting anything new through the bank regulators, and even I think investors are going to have a pretty cautious, understandably so, eye towards investing in neobanks right now. But I think we're still sort of long-term bullish and undeterred, and are looking at opportunities right now in the space. Yes.
It's Phil Donahue thing now, you got it right.
Hey, Darren Wolfberg, Triangle Systems. A good data point to support the ERISA comment, and preservation of capital. If you took the top 25 cities in the U.S. on coastlines versus the top 25 cities in the U.S. not on coastlines, and just from home value, not commercial value, you're looking at $21 trillion of value versus $5 trillion of value. So saving coastal cities is really important.
The question?
Everyone, just an easy question for you. Are you long SPY at 400?
No, sir. I suppose always a bit of a cautious bull, but I see no big reason, Andrew, to jump in front of the Fed move today. I mean, The two real negatives would be a 50 basis point move to the upside or a 25 basis point move to the downside. I think a 25 basis point cut, the reason I say it would be negative is it would imply, I think, to perhaps a lot of you in the room, but certainly any of the traders in the short term, that the banking crisis is worse than they thought. Because again, armed with the same data last week, Ms. Lagarde moved rates up by 50 basis points in Europe. If we all of a sudden cut them, I think the perception would be, it must be worse in the United States, they're hiding something, they've been flooding the market with cash somewhere, through M1 and M2, that we're gonna see something bad pop up next. But right now, as we are, I think we've shrunk from 100 basis points differential between the 2-year and 10-year. Many of you guys know when they invert, as they still are, it's usually a sign we're going into a recession, or already in one. It was 100 basis points last week, now it's 60, I think, or something like that. So the more that shrinks, the better chance we have to buy at 400 the SPY, and I would only do it through a call spread or just straight out calls. Thank you, sir.
So with that, Rush, you're gonna break for lunch, and I know
Okay.
you need to go.
I do.
And I would say, if you need a room for your,
Oh,
They will set up.
you were nice enough to
all right.
help us.
Can I make one shameless plug, not to sell it?
Right before I say, we did a poll,
Yeah, no shameless plug?
Yeah, shameless. I've seen a lot of them today, but, we did a poll.
Yeah.
We said, you know, is it 0, 25, 50, and, 25 came out of the gate fast. 0 almost won, and there was one person who went negative 25, Andrew.
Ah!
All right, shameless.
So shameless plug, so, full threads of
You'll get
blockchain
credit.
available on, Twitter Spaces, Spotify, all that, please tune in. And then we have a big, if you're a data nerd like we are, we have a conference coming up in May here in New York City on the Intrepid, May 17 and 18. Steve Richard from my Battlefield team, there, the handsome red-haired gentleman there. We would love for all of you to learn about that. I think we're gonna invite the 361 family to join us.
We're already
So-
invited.
Yeah, well, there you go, inviting you again. That's it, thank you so much, everybody.
Thank you, guys.
So, grab some food, replenish, breathe, as someone said earlier, move everything back.
Come join our 361 firm community of investors and thought leaders. We have a lot of events created by the community as we collaborate on investments and philanthropic interests. Join us.